Good morning, ladies and gentlemen. I hope you are all doing well. Whoever is interested in making serious money, no matter how little capital you have, I want you to pay a very close attention in understanding the dynamics of these markets, especially understanding the futures. Because if you do, I have personally seen very huge growth in a very short period of time. Okay? In a very short period of time. So I believe you could be able to listen closely if you want serious money. Because just to say, 2% in the spot market is 20% in the futures market. Okay? Just 2%. 2%. If you're looking for 0.3% in the spot market, in the futures market, where someone is looking for 3% in the spot market, it is 0.3% in the futures market. Okay? If someone is looking for, I've told my friends where we are testing this, that you only need 1%, just 1%. And I've been taking 1% on my trades, just 1% on the futures market, just 1%, a simple rise in the market. And so I want you to pay very close attention. I know at the right time I'll come in, but not now. Just 1%. Just 1%. And the income is tremendous. Is Magluva Bankwata. Yes, the income is Panquin Ponka. The income is Talaquin Bangwiva, even with very little investment. So I want you to pay very close attention, because no matter how much capital you have, you can really build a huge trandeminous Kampakwa using this opportunity. And using Royal Q gets a little bit simpler. I know the teacher is gonna break down. I want him to, he's gonna give you a very good understanding. At the right time, I'm going to come in, because I'm so much strategic. Yes, I'm so much into being strategic. I'm a strategic guy. But I know the teacher is gonna come in here, and then he's gonna help you understand what are futures, how do they operate. So I will come in at the right time with a strategy. But it's very important, those of you who are new, to understand, because this is a Damarikwa. This is a Damarikwa of money. Yes, it is a Damarikwa of money, ladies and gentlemen. And if you are not very serious, you might hate yourself why others are making money and you are not making money. So I don't know whether the trainer is on the house, is going to help you understand. Because before we bring strategy, you must be able to understand what are futures. But Royal Q, it is even very hard for you to get liquidated. Very hard. I was speaking to my friend the other day and he was like, they are going to liquidate you. It is very hard, very hard. I don't know how hard I can explain. But when the right time for strategy comes in, I will come and we share strategy. But now, today, and tomorrow evening, we want you to understand, just to understand. I'll create a special class on Friday evening. I'll be here for strategy. But today and tomorrow evening, it is to understand. So if you are interested in a Damarikwa of money, a Pankwa Calyptic of money, a Simplita Concata of money, pay very, very close attention so that you can listen so that you can listen. Because this is another subject. We no longer now need the bull run. We are less interested whether it is bull run or bear market. We are going to make sure that we contemplatively collect as much dankarikwa as possible. Thank you so much for joining our call for today. Allow me invite a super leader, a man from another mother, the man that comes from Ghana, already confirmed I will be in Ghana. Yes, the dates, I don't know whether they have sorted the dates, but on the 19th of next month, we are going to be in Jinja. The venue is going to be confirmed. In July, we are going to be in Kampala. And we are going to confirm the dates of Ghana because we are going to be in Ghana, in Accra, so that we share this country of money. So ladies and gentlemen, allow me invite a gentleman that is going to share with you a very good market that gives you a country of money. And this is none other than my brother, Mr. Emmanuel Owusu, all the way from Ghana. Welcome, sir.
All right, thank you, my leader. Okay, good morning, crypto ambassadors across the globe. It's another wonderful day, and we have no excuse than to make money. That is the reason why we are here this morning. So, from the opportunity given, we are going to learn a lot of things about our concept on understanding the knowledge about cryptocurrency, right? Especially with regards to trading on the futures market. So, I'm sure your pen and your paper is ready to learn something new and interesting this morning. All right, so I'm not going to speed up the lesson. I'm going to take time so that everyone can be able to understand and learn something meaningful this morning. All right, so okay. All right, so yes, so it's being recorded. Okay, for the sake of those who are requesting for recording, so it's being recorded. All right, so guys, let me share my screen for us to start right away. Let me share my screen for us to start right away. Say okay. All right, so now I guess my screen is visible. You can see my screen now. If you can see my screen, give me one in the chat. You can see my screen, give me one in the chat. If you can see my screen, give me one in the chat. Okay, so let's see if you can see my screen. Okay. All right. All right, so let's start now. Trading on the futures market is something simple, and crypto ambassadors, it's our core responsibility to ensure every individual or every trader understand how the futures market works using Royal Kill to trade and maximize profit. So if you are here this morning, pay attention to this lesson. I'm going to start from the scratch, explain the basics to you for you to understand, just like our leader said. So once you've been able to understand the concept of trading on the futures market, now you get a strategic or non-strategy that will help you to maximize profits, that is called abnormal profits on the futures market using Royal Cube. And this is so interesting, right? So now, discussing about futures markets, there are no complications over here, and it is something simple to understand. So how does the futures market works? Now, I know you have knowledge about trading, you have knowledge about how the spot market works. So I would like to bridge that gap from there for you to get the concepts. Okay, so let's go. Now, We said when we talk about trading on the futures market, it's just something brief, talking about how the trader can be able to predict the market on either taking advantage of shorting or longing the market. And when we say someone is shorting or longing the market, it simply means a trader or the trader is thinking or predicting on either the asset is going to rise or it's going to fall. And when it comes to the crypto market, we know that the market moves in mostly two trends, or basically three trends: an uptrend, downtrend, and then also ranging or sideways markets, right? Out of these three trends, basically we follow two rules here, that is an uptrend market or downtrend market. This simply means that it is highly possible for every trader to know how he can maximize or know how he can take advantage over these two side of the market at the same time. Over these two sides of the market at the same time. So when it comes to trading on the futures market, the trader focus on how he can size opportunity by shorting the market or longing the market. So unlike the spot market where the trader focus on buying an asset at a lower point and then expecting the price to rise, over here the trader focus on how he can also buy an asset at a higher price and sell it at a lower price, and then also at the same time how he can buy an asset at a lower price and sell it at a higher price. That is shorting and then longing. Now, before this will be able to happen, the trader need to understand what they call leverage or contract on the futures market. Leverage or contract. So the futures market is a market based on contracts. Let me turn off this. Okay. So the futures market is a market based on contracts. How does it becomes a market based on contracts? So unlike the spot market, when a trader sets up a trade, he owns the assets. The trader owns the assets on the spot market, but on the futures market, the trader do not own the assets. He is signing up a contract on the futures market. So you sign up a contract. What is the implication of the contract? Either you are longing, predicting on longing the assets, or predicting on what on shorting the assets. Then the trader predicts on longing the asset or shorting the asset. That is the contract. So you either take advantage of shorting the market or longing the market. That is the first rule. Now, how does leverage? So in terms of the contract, we said you apply what you call leverage. Leverage. So how does the leverage works in the futures market? Okay, when we talk of leverage, what is leverage? So pay attention to this aspect of the lesson. Pay attention to this aspect of the lesson. It is very, very important for you to learn and understand. Okay, it is very, very important for you to learn and understand. So how does leverage work? So now, leverage. When we talk of leverage, leverage is what gives futures trading meaning. So when it comes to trading on futures markets using leverage, we said leverage helps the trader to expose little amount of money to the capital or amount of money to the market to generate profit. Okay, so the leverage helps you like a borrowed money. So the trader borrows money from the system or from the exchange to trade by exposing little amount of his original capital. So when it comes to leveraging, the trader is borrowing money. It's a borrowed money that they are giving to you, right? Now, how does it become a borrowed money? So let's assume a trader goes into a market. As a spot trader, maybe you may tend to have $50 to trade. That is your capital. So coming onto the futures market with a leverage, you may get an opportunity to increase that amount or expose more of these $50 as compared to using only the $50 in the market. This means that so you may see something like 2x, 5x, 20x, 10x in the market. Now, so if I'm a trader on the futures market and I choose to go for a leverage of 2x, it simply means that I want to have an exposure of about $100. That is 2 times of my initial capital or my original capital, which is $100. Now, why am I opting for this leverage? Why am I opting for this leverage? Pay attention to this, because I want to magnify the moves on my on my margin or on my original money. I want to magnify or expose the moves on my on my margin or on my original money. So another term comes here that is called margin. So the margin is the original money you are using. That is your capital. That is called your margin amount. So I want to use this leverage as a tool so that I can raise more power in the market. And when I have a leverage, the work of the leverage, pay attention to this. The work of my leverage is not just to ensure I make more profits. The work of the leverage is not to ensure I make more profits, but the work of the leverage is to help me magnify my capital in the market. The work of the leverage is to help me magnify, to expose more capital to the market. That is the idea. This simply means that if I have leverage, if I'm using leverage in the futures market or in trading, I'm able to use less opportunity based on price movement to magnify what profit, right? So I'm going to take time to explain or define some terms here which are so familiar to know and understand on the futures market. Now, before I proceed, let me come back. Maybe I'm moving very fast because I promise you to go slow. Am I moving very fast? Am I moving fast? Or someone is saying, I can't see your screen. Please, is my screen visible? Is my screen visible? Is my screen visible? Okay. Okay. All right. Very good. Okay, so if you can't see my screen, then please check your network. Okay. If you can't see my screen, then check your network. Right? Very good. Okay, now let's proceed. Let's proceed. So let me take time and go slow so that you can understand this. So for you to understand the futures market, there are some few terms or few things that you need to know here. That is, one is your leverage. So let me introduce the terms for you. Now I will take time to explain each term according to how you need to understand them. So the first thing is your leverage. The next one is your margin. Then the next one is price movement. Okay. Now, I'm going to take time to explain this to you because if you're not able to understand this, you will never understand the futures market. If you're not able to understand these three concepts, you will never be able to understand the trading on the futures market. Right? Now, these three terms are important in the futures market because they work hand in hand and they constitute your profit generation on the futures market. These three terms constitute your profit generation on the futures market. So you need to have fair knowledge about what? About this. Now, we said when we talk of the leverage, right? When we talk of the leverage enhances you to make profits based on price movement. Price movement. So this simply means that when a trader is trading, the more leverage he uses, the less price. Listen, when a trader is trading, the more leverage he uses, the less price need to move. the more leverage you use, the less price need to move. So the main work of the leverage is to help price movements. Now in trading, it is the price movements that helps a trader to make profits. Listen, it is the price movement that helps a trader to make profits. So you are focusing on getting a leverage because you want a little price movement to help you gain fast profits. So we are not talking about more profits, but fast profits. Pay attention to this. We are not talking about fast, more profits or huge profits, but fast profits. So that's the reason why I said the leverage helps you to magnify your moves on the margin. Are we learning? Are we learning? Are we learning? Okay, so someone say reduce speed, however. All right, that's fine. Are we learning? Are we learning? All right, very good. Very good. Very good. Let's proceed. Let's proceed. So when it comes to trading on the futures market, using leverage is not about huge profits, but about fast profits. Pay attention to this. Using leverage is not about huge profits, but instead fast profits. So if you go for more leverage or huge leverage, the work of the leverage is to help you get a little or less price movements. This means a little price movement because of your leverage. Anytime there is a little price movement, the market helps you to help get that gains fast or that pain fast. With the leverage, the work of the leverage is for you to make profit on the price movement. So when the price move very fast, because of the leverage, you'll be able to earn fast profits or fast pain. You get the idea? So fast profit. You get it? So it helps you to magnify or as based on that exposure, what you are magnifying to the market, now you'll be able to earn fast profit. That is the idea of trading on the futures market. So when it comes to trading on the futures market, you see leverage, and that is the work of the leverage to help you earn fast profits based on price movement. Now, what is margin? So the margin becomes the original money or your collateral money or your insurance. Why am I calling or using these terms? Either collateral or insurance money. Because you borrowed an amount of money based on the leverage, because you want to make fast profits, so you want more exposure, you want to expose more into the market for fast gains. As a result of that, you think of getting what we call leverage because the system is borrowing you something for you to raise that potential to make your fast gains in the market. Because of that, anytime there is price movement or fast price movement in favor of you, you'll be able to generate your fast profits and then go out of the market. In same manner too, anytime there is fast price movement against you, the exchange is saying that, okay, since we borrowed you that money, you are using this money as your collateral because we wouldn't expect you to take our money out. So that is the reason why you have your margin. Okay, now what about price movement? When we talk of price movement, actually, what is it? When we talk of price movement, what is it? So pay attention and then listen. That is very simple, and that is the most important thing you need to know. That is very simple, and that is the most important thing you need to know. So price movements. Let me use PV because of my screen. Price movements. Now, in trading, traders make profits based on how fast a price is able to move. Listen, traders make profits both on the spot market and on the futures market. Traders make gains based on how fast price is able to move. So specifically, when it comes to the futures market, traders are able to make profits fast based on fast price movement. Listen, traders are able to make profits fast. Listen, not huge, but fast based on price movement. So when the price move a little in favor of your direction or your position, we said your trade has been sold. How did the trade get sold? Because there was a fast price movement. So when we talk of price movement, that is it is the real action that's help the trader to create profits and loss in the futures market. So it is the price movement that's help the trader to create profits or loss on the futures market. So let's assume this is a trade, okay? This is a trade. Let's assume the price of an asset is 120. Yeah, I like using Solana a lot. 120. Okay, so now the trader is on a position of long. Now you understand long. On this long position, we're expecting the price to move upwards. So if the price is able to move from 120 to 121, you are expecting to make profits. Now, because of your leverage, this little price movement is it's going to help you make profits because of the leverage. You are being able to make fast profits here because of the leverage that you are using. So the little price movement would help you to be able to make fast profits on your trade. And the little price movements here against you would also help you to make a little loss on your trade. Are you learning? If you are following, give me one in the chat. If you are following, give me one in the chat. Okay. If you are following, give me one in the chat. If you are following, give me one in the chat. If you are following, give me one in the chat. Okay. All right. Now let's proceed. Okay. Let's proceed. All right. Okay. So now what we are saying is that when we talk of the margin, the margin happens to be your collateral money, or let me use the word your original money. The money you have is your margin. So let's assume I'm in the market with a capital of $10, a leverage of 5x. So my margin is $10. My position size. So another word has been introduced here. Position size is $50. That is 5 times 10. That is going to give you 50. So the $50 becomes your position size. And then the $10 becomes your margin. The $10 becomes your margin. So with the margin is what you are using as collateral against the $50. The margin is what you are using as collateral against the $50. So the margin is your original money. And that original money is what you are using as maybe the prayer warrior will call it point of contact. You are using as a point of contact. So that is what you are using as a collateral against the position size, which is $50. Now, what happened to your margin? So whilst I'm expanding the lesson, I will explain detailed into that. So if you want to understand the margin, see the margin as your collateral money or your original money. And then the leverage amount is your position size. The leverage amount is your position size. So you go into the market with this margin, which is 10, with a position size of what, 50. This means anytime there is a little price movement, what we are saying is that anytime there is a little price movement in favor of your direction, if you're on long, so this will be your direction, the price would have to move up or rise. Anytime there is a little price movement, you expect fast gains because you've exposed more on your odds of that trade of the assets based on your position size. So the profit you are making is based on the price movement, the margin, and then also the position size, not just one. If the price move very fast, the work of the leverage will help you to make fast profits there. Right? And in same manner too, when the price moves against you very fast, it's also going to affect your fast losses in the market. Now, what we are saying about the margin is that the next thing that you need to understand about the margin is that when the price moves against the trader, so when there is fast price movement against the trader, the system thinks of taking out their borrowed money. And since they take out their borrowed money, your margin will be empty, affecting the trade. So that is where you see what we call liquidation. So I'm introducing another word, liquidation. So liquidation happens when the price moves against your trade. When the price moves against your trade, that is when we say that there is liquidation. So in this sense, your collateral amounts will be used to pay for what you borrowed. So take this as example from the banks. Let me still come back more on the margin. So for instance, you go for a loan at the bank. Okay. Now the loan that you've gone for, you need to deposit something that the bank will use as a point of contact on which to give you the loan. So sometimes people take in something what we call collateral, maybe a property that may be in the form of car, house, land, or any other thing. Now, they are giving you the money because of the property or the collateral you've served. This means once the contract is flout, when will the contract be flout? That is when you are not able to pay the loan on time. When you're not able to pay the loan. Once you are not able to pay the loan, they will have to sell this car, this house, or this land to settle their money. Because they will never want you to go away with their money. Right? So whatever you are using there becomes your margin. That is your collateral. So once the contract is abused or is flouted, they have to use the leverage, they have to sell the leverage, they have to sell the collateral or the insurance so that they can take their money back. That is the meaning of the margin. So though the margin is your real money, but you are using the margin to bargain for something good. Because you want to make fast gains there. Since you think of making fast gains, you are using your money to consider making fast gains on the price movements. As a result of that, when you're able to succeed in the contract, you go scot-free with profits. When the contract is not able to succeed, they take that amount of money which you are using as what? As collateral, because it no longer belongs to you. Now, what makes it so convenient and trusted? Are we learning? Are we learning? Are we learning? Very good. Are we learning? Are we learning? All right. Very good. Very good. So now, you can't think, eh? All right, let's proceed. So, all those questions will be answered. Now, follow the process and let's learn together. I'll give you the opportunity to ask all your questions. Hmm? So, now, when you come to the leverage, think of the leverage as a tool that will help you to gain more power. Okay, think of the leverage as a tool that will help you to make to get more power. That is what you need to know. And think of the margin as your collateral amount, which is serving as a point of contact for you to make fast gains in the market. And then think of the price movements as your potential strength to make fast gains, to make profits or to make losses. That is the idea. So without using margin, your leverage wouldn't work. And then also, or it will be useless for you. And then also, without price movements, both your margin and then your leverage will be nothing. That is what you need to know. So what you need to understand when it comes to the leverage, whilst I'm proceeding to the next thing, what you need to understand when it comes to the leverage is that the leverage doesn't increase your own profit, but it rather multiplies your exposure. It multiplies your exposure of trade based on the margin that you've provided for fast gains. So it amplifies. That is another word that I can use for that. That is another word that I can use for that. So it amplifies your potential for fast gains in the market. Can you proceed now? Can you proceed? Can you proceed? Can you proceed? Can you proceed? Very good. Very good. Very good. Now we can proceed. Now, what makes trading here so unique? And why should we trade on a futures market? Why should we trade on the futures market? Now that you've understood this concept, let's proceed. So, some have got the idea. Before I proceed, now that you've understood the leverage, you need to make good use of the leverage than abusing the leverage. So sometimes I see traders, some people think if they are able to use like 1,000 leverage, 1,000x, that is when they will make huge profits. Okay, so what you need to understand of the leverage as I'm proceeding is think of the leverage as helping you to make fast profits instead of huge gains. The leverage is there to help you to make fast profits instead of huge gains. That is what you need to understand. Now, why should we trade on the futures market? Now you know that you can be able to take advantage over both sides of the market. You can be able to take advantage over both sides of the market. That is both on rising markets and then also falling market. That is on an uptrend market or downtrend market or bearish market or bullish market. So let me tell you something. Crypto ambassadors has always think about you and always want to project a vision which would ensure that you will always make good profits, you will always progress in your business, and you will always grow. So thinking about this, either the market is in bullish, remove. If the market is in bearish, remove. Do you understand? If the market is in bullish, we move. If the market is in bearish, we move. So we are taking advantage over both sides of the market all the time. Now, when it comes to using Royal Kill, I've always praised this and I'm always grateful for this opportunity. Now, coming here, what makes it so unique here? Pay attention to this. Pay attention to this. Royal Kill provides strategies for traders. Listen, Royal Kill, look, if you don't understand Royal Kill, sometimes if you are not smart enough, you find it difficult understanding Royal Kill. Royal Kill provide trading strategies that helps traders to maximize profit. That helps traders to maximize profit. Looking at the strategies Royal Kill provides and the strategies that they implement in the bot itself, you realize that it is so unique for smart traders. For smart traders. For smart traders. Okay. So this opportunity that Royal Kill provides, the strategy that Royal Kill provides for smart traders to make good profits in the market. So Royal Kill considers you as a smart trader, not just an ordinary trader. We have two types of traders. We have ordinary traders and then also smart traders. When we talk of the ordinary traders, mostly they call them normal retailers. And then also we have smart traders. Smart traders implement trading strategies to make profits. Smart traders implement trading strategies to make profits. And then ordinary or retail traders think of how they will make profits from the market. Don't be confused here. When we talk of retail traders, always smart traders win the market and the retail traders stay in the market. So when it comes to the futures market, what I've come to realize is that the implementation of Royal Kill on the futures market is more of smart trading concepts. So what does smart traders do? If you like, you can go out to search out to know what smart traders do. Smart traders use what you call the scale profit based on DCA, dollar cost averaging. Smart traders scale profits based on dollar cost averaging. So when it comes to using Royal Kill, the way you can maximize profits after you've understood all these concepts, one, this is it. So one, by opening margin calls, margin calls, or applying DCA. Let me use DCA for you. By using DCA in your trade, and then also you also have the opportunity to hedge your trade. You also have the opportunity to hedge your trade. And then the last thing that I will talk about is you also have the opportunity to use what you call smart stop loss. You've never heard of it. Smart stop loss in Royal Kill. This is so unique. This is so unique in Royal Kill. And after understanding this, you have thousands of reasons why to trade using Royal Kill as compared to doing manual trading. Right? Now, let's move to the first thing. So when I'm using Royal Kill, when you're using Royal Kill, now the trade gives the trader, or you have opportunity to use ahead of 20x leverage. And I say this is standard. This is standard. 20x is standard. 20x is standard. According to proper risk to reward ratio, 20x is standard for every trader. That is the reason why Royal Q provides the highest of 20x. If you think of 30x, 50x, you are just risking your intestine. You are just risking your intestine. Yes. You see, when people don't understand the leverage, they think using high leverage is what is going to perform the magic. It's about maximizing the profits, getting to know the strategy. So it gives you up to 20x leverage to use. Now, with this 20x leverage, when you come into the market, because of different price movements in the market, trader is able to use what you call DCA by applying margin calls in the market. By applying margin calls in the market. So how does it work? So one, Royal Q gives you the opportunity to set up your strategy on what you call margin or cross margin. Okay, cross margin. Now with cross margin, you will be able to buy your trade in batches. Okay, you will be able to buy your trade in batches. So let's assume with $100 capital, you wouldn't expose all the $100 to the market because you have a strategy set up on what? On cross margin. And with cross margin, that is where you'll be able to buy your assets in batches and make profit on it, even when the market goes against you. So this is the difference between smart traders and the retail traders. Let me explain this to you. This is the difference between how smart traders trade and how retail traders trade, and why Royal Q applies smart trading. Now, pay attention and listen to this before I continue to explain the margin calls. When it comes to smart traders think of how they will always abuse the stop loss. So when you talk of a stop loss, that is a point. So let's assume you have $100 to trade. You set a target. When the market drops to this point, automatically you'll be executed out of the market, or you'll be exit out of the market. So smart traders always ensure that where there is a stop loss, they will go below the stop loss to make profits. Because once the market drops below your stop loss, it begins to rise again when you have been terminated out of the market. So mostly those who uses stop loss, that is actual stop loss in their trading, once the stop loss is hit, you are out of the market. But the smart trader would rather bridge the gaps by trading in batches. So he will fulfill this gap by buying part of a trade on top of your stop loss, then below your stop loss. So once two trades are bought below your stop loss, now the profit will increase. Let me go over this again. This is your stop loss. Pay attention to this. This is your stop loss. So there is a trade here, and then over here, this is your stop loss. Now, once the trade triggers here, you are out of the market. But a smart trader wouldn't think of being out of the market because the market will just come below your stop loss and then reverse back again. So once the trader think of using this opportunity, the smart trader thinks of how he can bridge the gap to fill the stop loss. That is what we call it, the average prices. Look, you don't know. That is what we call it, the average price. So anytime you are bridging up this gap, you fill the stop loss there. That is how smart traders trade. So they think of how they can bridge the average prices by filling up those stop loss. Are we learning? Let me know if I'm not running. Are we learning? 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 Very good. Very good. Very good. So it's simple. I don't want to complicate anything here. I just want to let the lesson to be simple for you to understand. So you see, whilst the manual trader is being terminated out of the market because of his stop loss, now the smart trader filled that bridge, because what makes the trader get out of the market is because of the stop loss, because he's not able to fill the difference between this up here and then the down here. Now, this is where the liquidity lies, and this is where the profit will begin to be generated. So if a trader would think of how you fill this gap between here and then here, always you make profits, because below your stop loss is liquidity. So think of liquidity as the soil is of the nutrients where the food is beginning to germinate, or it's beginning to penetrate into the market. So now the fool is out of the market because of stop loss. He's out of the market. Now that is where the smart trader begins to eat. Once your stop loss is out of the market, the liquidity begins to pump, because they uses you there to make profits. So you think about this, you realize that indeed, if traders are using this opportunity, then why don't I also scale on that opportunity? Now, it's so interesting. Once you understand this, you love Royal Kill. It's so interesting. Okay, let's proceed. Before we proceed, I will let you learn something. Okay, I'll let you learn something. Now, quickly, you've been taught how to use AI. I want you to learn something this morning. Let's go. Let's go. I want you to learn something this morning. For you to know that you have the tool to make the money, and you are acting more than a smart trader, yet you don't know. Come here. Now, pay attention. What strategy do smart traders use without? So, no. Come here. Why do, why is, or why does, English is English now, why does smart traders don't use stop loss? And what strategy do they use? What strategy do they use to scale profits? So I just want you to learn something brief here before we proceed. Okay. I want you to learn something brief here. So let's see. Okay. Okay. So let's see. Let me see. So key away from students. Institutions don't use stops at all. Institutions don't use stop loss at all. Right? They don't broadcast stop loss. Risk is controlled by hedging. Listen, risk is controlled by via hedges, engine-based kill switch, and then size rulings. Okay, so that is one. We talk about hedging. So relative to teach, they don't broadcast stop loss. Risk is controlled by what? Via hedges. That is one. Now come here. So let me see. Delta neutral option. No. So smart traders do manage risk, but they hate broadcasting it. Good. So they hate what? Broadcasting the risk, they do what they use. Now, position size and then algorithm soft stops. So a risk engine watches trade by trade, P&L, and then notional. Right, this is just too much. Let me, what other strategies? do they use? Do they use that normal traders don't? Okay. Okay. So uh all right, anyway. All right. Anyway, so let's proceed. So at least you've got to know of what hedging. So they hedge their trade. That is one unique thing. So what I'm saying is that listen, what I'm saying here is simple. What I'm saying is that when it comes to using Royal Q, the easiest way to cover up the breach of making profits is by taking the size of opportunity by averaging the price of your assets. This means you are not going into the market with all your money at a go, but you go into the markets at different budgets by buying the assets at different, bridging the gaps to make what profit. Where there is a necessary stop loss, that is where you have to get your liquidity to make your stop loss, and that is a unique strategy that most smart traders does what uses to make profit, right? Now, the next thing that you are going to see in Royal Q is what you saw there, that is hedging. Hedging. So I'm briefly talking about all these ones. Tomorrow, if God permits, Thursday, we will discuss more on how to hedge a trade. That is going to be pure trade settings. So you set up a trade on that. Now, hedging. Hedging. How does hedging also works? And hedging is also another smart way of making profits in the market, right? Now, we know that the market goes in different direction. That is uptrend and then also downtrend. On an uptrend market, what do a trader do? On an uptrend market, what do a trader do? On an uptrend market, what will a trader do? If you see a market on an uptrend direction, what will you do? If you see a trade on an uptrend direction, what will you do? What will you do? Very good. Very good. Very good. So if a trader follows an uptrend market, that decides to do what long or buy. So long the what? Long the assets. And it vice versa. So if it is also downtrend, the trader decides to short the assets. Very good. Now, the secret here is that as a trade, as a trader opens a trade on long position, there could be what we call price reversal. Price reversal. Now, when there is a price reversal, that doesn't mean that you've run losses. That doesn't mean that you've run losses. Now, your margin calls are being bought or and then it keeps filling the average price. Notwithstanding, a trader can still see opportunity in the market on the same asset where that asset is dropping in value. Since you are on long and the asset is going on short, the trader can hedge the trade. That is, if you have capital, you can choose to hedge the trade and hedge profits on the short direction of the odds of the market. After earning that profits, when the market reverses back to the long position, you hit back your profits. That is back to back. This is called back to back profits. Back profits. Yes, back to back profits. So when you talk of hedging, it is the ability of the trader to think of how he can make profits on the same assets on different directions. So think of this asset, for instance, like on the spot market, you see you buy the assets and expecting the price to rise. The assets keeps dipping and dipping and dipping until it dips you yourself as part of the market. Hmm? In this case, what the next trader can do is that the trader can think of it if it is on on a futures market, a trader can think of whilst he's on long position, he can also think of shorting the asset because it keeps dipping. And since it is dipping, there are opportunities in the dip where you can make money. Right? So in that case, you hedge the trade. This simply means on the same trade, on the same assets, you can trade or open two on the same asset at the same time. You can open two positions on the same asset at the same time. So mostly what smart traders do is that smart traders think of how they can size opportunity in both directions of the market by bridging parts of the what of the assets. So while they are on long, they see opportunity on short, they short the market. Whilst anticipate profit on the long, they also make profit on the short position. And this is the exact strategy Royal Q is providing to the traders. So this means you can hedge the trade and make profit both on the long position and then on the short position. Is that clear? 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 Very good. Very good. So guys, let's proceed. Very good. Very good. Now let's proceed. So you see, when it comes to trading on the futures market, there is nothing to stress yourself about. It's just about understand. That's the reason why we are taking time to learn and understand. So once you get a strategy to apply, then it's called free move. You see, so when it comes to using Royal Q to trade, look, I've seen a lot of manual traders. Even was this last week? There were about 1 million liquidation in the futures market because of Donald Trump and then Elon Musk beef. There was about 1 million in the market. I never see any Royal Q trader getting liquidated. And why? What is so unique? You see, because of the strategy that we have, because of the strategies that we do, what we have, and we've been implementing them in the market. They say liquidation is in trading. Of course, it's true. But it's very difficult or hard for you to see a trader, Royal Q user, getting liquidated. Do you get it? It's very difficult for you to see a trader getting liquidated. Why? Because of the strategy that we have. Unless you refuse to act according to the skill that you need to act on. Do you get it? So we have the smart way of making this opportunity work. And it's just about understanding, having a fair view about what you are doing and knowing exactly what you are doing and then doing it right. So now you'll be able to hedge the market, open average prices on different assets whilst bridging the gap to make what? Profits. And this is so unique. This is so what? So unique. So whilst I will end for you to ask your questions because your questions will help me to be able to teach you more or expand more to you. You have to understand whatever we've discussed here, the key concept that we've discussed here. That is your leverage, your margin, the price movements, liquidation, and then also liquidation price. And one thing that makes it so different from other forms of trading is the liquidation price. You set up a trade and you see your liquidation price targeted and you feel so calm. And the one amazing thing is that if you also create average prices, it also help you to create new liquidation price. And when we talk of the liquidation price, let's assume a trader set up a trade on, let's say, Solana, let's say 200 on a price of 200 USDT Solana. Okay, so you are on short position. Being on short position, it simply means when the markets rise, you wouldn't be happy. So you are expecting the market to drop more. Now, you see a target or a liquidation price of, let's say, 350. This means until Solana rise to 350, you'll still be enjoying in the market. You will still be in the market until the assets rise to this point. Now, in as much as you are creating new average prices, your liquidation price also increases. It goes far away whilst you enjoy your profits. So that is one also unique thing that makes trading on the royal queue to be so interesting. And it makes you feel so calm in your trading, right? It makes you feel so calm in your trading. That is the ideal game. Now, let me give you the opportunity to ask your questions. Now, you've understood the leverage as not what's going to give you huge profit, but rather it amplifies your margin for you to make fast gains. Let me give you the opportunity to ask questions so that I can be able to clarify more for you. So, let me see. Okay. So let me clarify this too. So please, why Binance charge funding fee? How can it be avoided? How can it be avoided? So now let me when we talk of funding fee, please pay attention to this. When we talk of funding fee, this is general thing for all leverage, all those who leverage their trading. Okay, it's not only on Binance, on all exchanges, on all exchanges. It is a rule in trading, not on Royal Kill, not on Royal Kill, or not on Binance. It is a general rule in trading using leverage. Now, when we talk of fee, fund fee, this is a fee that is paid between long and short traders. Between long and short traders. This is a fee that is paid between long and short traders. That is about 0.01%. 0.01%. So it's either long traders are paying short traders or short traders are paying long traders. This is how it works. This is how it works. So if we are on long for 8 hours, 8 hours, every 8 hours, if we're on long, you pay fund fee of 0.01% to the short trader. And if you are also on short for 8 hours, being on short for 8 hours, the market has gone against you for the past 8 hours. You pay fund fee of 0.01% to the long trader. So this is not for Binance. Pay attention. This is for you, the trader. It's something you benefit. So you pay, I pay. So the long trader pays to the short trader. The short trader also pays to the long trader after every 8 hours. Is that clear? Is that clear? So fund fee or funding fee is something common in leveraging, not on Royal Kill, but it's a general rule in trading using leverage. It's a general rule in trading using leverage. Okay. So if I use would you please clarify more of fast gains in futures trading as opposed to huge gain in sports trading? Now, what we mean by fast gain is that on the sports market, you own the asset. So your profit making is based on the rise of the assets. Okay, you own the assets. So if the assets rise, that is when you make the profit. Because you own the asset and you have shares in the asset. Do you get it? But when it comes to the leverage on the futures, it is the price movement that affects your gains. So if it happens that you have high leverage, when the price move very little or small, it amplifies your what? Your gain. That is, you are able to make fast profits. That is the difference. We are talking about fast profits. So if once the price rise more, now because you have the leverage amplified, you'll be able to make profits. Not just profit, but what? But fast. So a little price movement, a little rise will make you a little profit. And a little drop will also make you the opposite. Do you get it? So when the market is able to rise very fast, then very fast you also make your profit. Then when the market is also able to drop very fast, then very fast you see the opposite. Do you understand? Do you understand? Okay, so let me see if there is any hand up. No, there is no hand up yet. So let me take the questions in the chat box. Okay, now fund fee can be higher than 0.01. It can be as high as 2%. It depends on the exchange. Okay, it depends on the exchange. It depends on the exchange. That is what you need to get it clear. So the problem I'm facing now, the robot multiplying my capital with a leverage of it gives me more profits based on margin position, not the leverage position. I traded Solana yesterday night with a capital of 15 USDT, take profit of 1.3% with a leverage of 20x, meaning my position was supposed to be 300 USDT, expecting profit of $3.9 instead of I got $0.19 as my profit. So, all right. So I guess maybe if God permit tomorrow, we'll do how to calculate for your profits. Okay, how to calculate for your profits. So if we learn on how to calculate for your profits, now you'll be able to calculate your profit to know how you're able to make profits. So the only problem is that sometimes we think that because you've increased your leverage, you expect that you should make high profits on the what? On the leverage. That is not the real deal. That is the reason I said if you get what I explained here to you very clear, I said the profit you make is based on the leverage gives you fast profit as compared to huge profits. That is one thing that you need to get it clear. So if God permit tomorrow evening, that is Thursday, we will discuss on how to calculate for your profits. So how to calculate for your profits, and then sometimes some traders see returns, maybe the ROI, that is return on investment, as let's assume 50%. So they think, why is that I set up a take profit of 2% and then the ROI was 50% and yet I didn't make huge profits. So I've prepared all these lessons clearly, and I have to ensure you get the fundamentals before we build up on the rest of the lesson, right? Okay. So we can proceed. Okay. Now let me take the next question. Okay, so you just need to learn sums. Very good. That is all. You see, once the mathematics comes in, some people will begin to run away. So I have to take time and then ensure you understand the basics. I have to ensure you understand the basics. I don't want to use math to mathematics to chase you. Okay, so now um are we using the same wallet both for sports and then future trading? So now when you are trading on the futures market, when you are trading on futures, of course you are using the same exchange, but you have to transfer your funds. If it is on spot, you have to transfer it from spot to futures before you be able to do a trade on the futures. Okay. All right. So if we have 250 as capital, how best can I set my vote on Royal Q so that I can get um something meaningful than the 0 point? Yeah, so you'll be able to get profits. Sure. So I think that has to do with trade settings. Okay, that has to do with trade settings. And then the amount that will be liquidated if market goes in wrong is those all my capital used to trade a specific coin or as per take profit you choose. So when it comes to the futures market, okay, when it comes to the futures market, before you be liquidated, it simply means that all your capital has been exhausted. So traders don't just get liquidated in the futures market. Once before you get liquidated, it simply means you've gotten to a critical moment where all the money you've exposed has been exhausted, and then your margin is equal to your liquidation price. Mm? Your margin has been equal to your liquidation price. That is when you'll be liquidated. So how much does one need to trade on the future? So, well, that one depends on your capital and then your strength. So that is it. So let me take the next question. If you want to use 15 as your first buy amount and want to x, you need to take then your first buy amount should be $300 because your 20x leverage, then from your capital only $15 will be used. That's borrowed the rest. So people should just know the simple math. Yes, that is. So take your time, guys. If God permit, tomorrow, like I said, I need to bridge the gap for you to learn the difference. So once you understand the meaning of the leverage, you wouldn't ever equate the leverage as what needs to give you the profit, but rather the price, what movement. That is it. So if God permit, tomorrow we will do the calculations. So then prepare for your pen and paper and then your mathematical head too. So I need to get the brain of mathematics here. Mm? So does liquidation means losing all the margin? Yes. So liquidation means losing all the margin. Yes. So for now, that is what we are using. We are using the strategy spots. That is the trade setup strategy on spot to trade on the futures, and it works very well. So that is it. Okay. Let me see if there is any hand up. Okay. So let me take the questions in the chat box. All right, so I think all questions has been cleared here. Can I change my spot floating loss to trade it in futures? Well, it depends. If you know the asset is gaining good momentum and you can either long or short it, it depends on you. So you can check it to know the state of the assets and then the position or the direction that you have to go with it. Okay, so what is the best leverage to use? All right. So I always advise that if you want to go for a leverage, at least 2x to 5x is enough. 2x to 5x is enough. 2x to 5x is enough. Look, let me tell you, it is dangerous. Listen to me. It is dangerous to think that, pay attention to this. If you have 15 dollars as your capital, I don't expect you to use even 10x. If you have 15 as your capital, now some people think if they go for high leverage, that simply means that they are going to make huge gains. That is not the game. That is not the ideal or the idea of the game. The work of the leverage is to amplify the moves. Pay attention to this. The work of the leverage is to amplify or magnify the moves on the margin, so that whenever there is a little move, you will be able to make fast profits. Mm? So that whenever there is a little move, you'll be able to make what? Fast profit. You'll be able to be out of the bucket very fast. That is the idea. Okay. Okay. So if you ask of the best leverage to go for, at least I don't understand why $15 you have to go for 20x leverage. Hmm? You want to blow your intestine? You want to blow your intestine? Maybe you've not understood what you called. We will still be learning. I don't want to be packing the lessons. Okay. So you need to understand proper risk management. So if you understand risk management, there is no way with $15 capital you go for a leverage of 20x or even 10x. Do you get it? Don't be greedy. You see, some of you, it is not anything that is killing you. It is not anything. It is your own greediness. Even on the sports market, the way people are too greedy, I still don't understand. So, which mode am I supposed to change such that the robot doesn't pick my money from one asset if the order is liquidated in case. So over here on React, we are using cross margin. Okay, so either if you're asking of the mode, start being mode real-time settlement is good for you to use. Then how to activate future trading. So please go to YouTube, we have the videos there. Go to YouTube, we have the videos there. You can go and watch it. So please, um I'm new in trading and I never traded before. Please, how can I set a signal on Royal with capital of $50? Okay, so from what we've discussed, please see your upline or your mentor to guide you on that. Okay, so if you are new, I'm sure you've activated your account. So since you've activated, based on what you've taught here, let your mentor or upline guide you to set up a strategy on the, just like what you've been doing on the spot market, and then set up a trade on the futures market. At least expose, listen, at least expose $20 to the market or $10, and then use $40 to as your margin calls. Expose $10 as your first buy amount, and then use $40 to open your margin calls. If you are greedy enough, use $20 and then use $30 to open margin calls. That is all. Okay, so in case the trade goes against me with leverage of 5x, I will lose 5% of the invested money, or I lose the whole amount. A whole amount is only loose when there is a liquidation. A whole amount is only loose when there is liquidation. You get it? In trading, you go in trade to win trade. You are expecting to win the trade. So once you win the trade, you are free to go. You are free to go. So when we are setting features, when I read setting features trading, I guess features trading are already ongoing. And yet, just like when we started, if you join us earlier, we said we are learning the basis, then a strategy will be given. So, exercise patient. Does the leverage affect margin calls also, or basically the FBA? No, both, both, both. Okay, so one hand is up. Um, you've been asked to unmute, so please ask your question. Hello. Yeah, we are listening.
Good morning, sir. Thanks
Good
for
morning.
the lecture. Sorry, for some of us that are using HTX, I think the leverage something is one. I don't know if there's any solution to how to set the 2 or 5% leverage, 5x. Because whenever I touched it, it will still come back to one. But I've been using the one like that. I just want to know if there's any other thing one can do about it. Thank you, sir.
Yes. So all right, you're welcome. Okay, so now, especially those having that issue, such issues, if you want to trade with more leverage, when you set up the trade, go into there and then increase the leverage in your exchange. It also affect the trade. So especially those using HCX, and then also is it Bybit and then OKX. It's a common is it either Bybit is part, but OKX. Those using OKX, it's a common thing on um the exchange. So when you set up the trade, after setting up the trade, go into your exchange and then increase the leverage in the exchange. Okay, so um yeah, so please, those who want to get more knowledge on that, all the video, the lesson that we've done, we've presented them on YouTube. So go to YouTube and then watch to learn more about everything. Okay, so please, is there any video recorded? Okay, so that is it. All right, so guys, I think that is all. If God permit, tomorrow is Thursday. Let me see if there is any other hand up. Okay, so if God permit, tomorrow is Thursday. 9 o'clock East African time. We are still going to meet again to learn more, especially when it comes to the calculation, how to calculate for your profits, how to calculate for your ROI. Some of you, when you see the ROI, you think because the ROI is maybe 100% or 100 or 200%, then you have to make huge gains. Okay, so we'll do more calculations on that for you to learn more about how it works. Okay, so it's very clear to trade on the futures market. You just need to understand the um terms involved and how to go by it. That's the reason why we are taking time to learn more about this. So prepare. If God permit, tomorrow we shall do more, learn more about the futures trading, especially when it comes to the calculation, how to calculate your profits, how to calculate for the position size, and then also how to calculate for your take profit price. And then also your take profit itself. So if you set up a trade and you want to know your take profit, how to calculate it before you make your profits, then at least you understand. And so that is the idea. All right. So let me see if there are any other questions to handle before we bring this session to an. Please, where in HTS can I go and increase the leverage? When you set up a trade, automatically the trade appears in your exchange. You will see the trade. So as you see the trade, just tap on the trade. I'm not using ATX for now, but I've tested it though. And I have some team members using ATX. So just go in the trade, you will see it there. As you see the trade, you can tap on it to increase the leverage. It's simple. So let me see. All right. So guys, I think that is all. So those who want a setup on how to set their futures accounts, please on Crypto Ambassadors platform, we will drop all the videos there. The tutorials will be dropped on the platform so that you watch and then also set up your futures account very nicely. Okay. So let's end here. So how long have you? All right. That is not part of our training. Okay. That is not part of our training. So yes. So I'm on ETX. Can I share for you to show? No, don't share your screen here. All right. So guys, I think that is all for today. If God permit, tomorrow we will still meet again. I wish you all the best in your trading journey and do well to learn more and understand, and always be optimistic to learn and then search for opportunities which will ensure it will help you to make more profits or make gains in the market. Don't be greedy, but be strategic. Listen, don't be greedy, but be strategic. Don't be greedy. That is my message for you. Don't be greedy, but be strategic in your trading. Don't be greedy, but be what? But be strategic. If you become strategic in your trading, you will always make profits and make profits to yourself. You get tired. So that is what I have to share with you this morning. I know you can do that. So go there, go out there, go and make the profits and share the opportunity for your friends, your loved ones, and everyone to join you so that we can all continue to win together and then make the world a better place to live. All right. So I wish you all the best and have a good day. Bye bye bye.